Hello, we're back again. Today, I want to spend some time on talking about the trading strategy and just make sure we talk about trading strategy for beginners as well as advanced traders. So it's going to be an important episode. It's one of those educational episodes that deal with the challenges that we're faced with. But however, before we get down to it, let's just talk about the updates that I had mentioned. So if we look at the two issues that we wanted to talk about, yes, it is correct. I want to confirm that Grayscale has applied for Cardano Exchange Traded Fund, ETF. So we still are waiting. The application has just been done recently. The rumors about a potential collaboration between Microsoft and Cardano, I have not been able to verify that. In the next coming episodes, when I do get the information, I will provide further details to it. If we move to the next update is about Ripple XRP. It's important to look at what has been happening to XRP. Like I've said before, XRP has been faced with a lot of pressure and, according to me, unfair legal lawsuits from SEC for a number of years. And I think the recovery of the Ripple has really been one of the good things for the crypto industry. But now they've just had an announcement about closing another client on Unicambio where they are using their payment system to do the cross-border payment between Brazil and Portugal. So they've just closed Portugal. Now we know that they already had existing clients, Travelex Bank as well, Mercado Bitcoin, between Brazil and Portugal, but now they've just added another one. So this is very important because now you would have the cross-border payments being done using the XRP native token. So this is showing a lot of good developments on XRP. And also Bloomberg just provided an update on the approval for XRP. And they are coming with a very bullish sentiment that they are expecting that there are higher chances of XRP being approved. In fact, they said the chances are 65%. So this is good news for XRP. And I think these things will help the token as well as the ecosystem in terms of just moving it forward. Okay, let's get to the main course of today. Now, today we are talking about the trading strategy. Now, trading strategy is very important, like I've said in the past. It's your roadmap in terms of how you trade. And what you trade, you can make your own decision, but how you trade becomes very key and very important. And therefore, we will talk about a number of aspects I want to talk about on the trading strategy. But I think number one, the most important thing is before entering any trade, it's crucial to identify the market trend. So the primary trends that you normally find in the market, one, you'll find an uptrend, which is the bullish trend, where prices make higher highs and higher lows. And then the second one is downtrend, which is a bearish market, where prices are making lower highs and lower lows, right? And then you get a sideways trend or a consolidation, where prices move within a range. That's that choppy trade. So how do you identify this, right? If you use a 50-day and a 200-day moving average, you can see if the market is in an uptrend or a downtrend. So take that into account. You go into your moving average, select one moving average as your 50-day moving average, select another moving average as your 200-day moving average, and then you would see whether the market is a downtrend or an uptrend looking at those moving averages. The second point is apply a trend line. So if you apply a trend line, the trend line will be connecting your highs and your lows, and therefore you'll be able to see where the market is moving. Is it moving high, or is it moving low, or is it moving within a range which is sideways? And the third one is check for higher highs and higher lows, which is bullish, or lower highs and lower lows, which is bearish. And it's important for one to do this. For an example, if Bitcoin is trading at about 50-day moving average, making higher highs, it's an uptrend, meaning it's safer to buy than sell, right? Just an example. Let's go to the second one. setting up your strategy is important. Therefore, the trend following strategy is important because that strategy follows the trend momentum using the moving average, using the relative strength index, the RSI, and also using the MACD, which is the moving average convergence and divergence that we spoke about yesterday. And this is how you would apply. Again, you would use this time a 50-day and a 200-day moving average. Remember, earlier on, we said you'll use a 50-day and a 200-day for you to see where the trend is going. This time, a 50-day and a 200-day moving average just to confirm the direction of the trend. So it's important for you to take into note that your 50-day and your 200-day moving average shows you the trend, and therefore use that as a confirmation just to check the trend when you want to understand where the market trend is moving. And then you use your RSI, your relative strength index, just for you to measure the momentum so that you can see if you're above 70, it means the market is overbought. If you are below 30, then you know that the market is oversold. So it's important for you to understand which technical indicator you use to check what in the market, right? And then the third point, your moving average convergence and divergence, that one confirms the momentum shift. So that's how you check whether the momentum has shifted or not. If you look at your trading plan, right? If you put a trading plan, step one of your trading plan will be first identify the trend. And we've said in order for you to identify the trend, you take the 50-day moving average, the 200-day moving average, and you look at where the trend is at. If it's an uptrend, you're looking for buy opportunities, right? But if you take your 50 moving day average and your 200-day average and the trend is going down, then it means it's a sell opportunity. Now, a sell opportunity means you sell because you get out of the asset, but it may also mean that you short the asset, which means then you go in for the positive confirmation. That's the trend you want to invest in, and therefore the more the downward trend goes, that's the more you would be making money in terms of that market and that plane. Step number 2, look at the pullback entry. This one is important, right? When prices move towards the 50-day moving average and bounce back in an uptrend, it's a good buy signal, right? And it's important for you to, so these are indicators. It doesn't mean in all cases this will be the point, but these are the tips that helps a trader just to go into the market, perform 1 or 2 technicals just for you to get the confirmation. So in this one, you're looking for a pullback entry. And therefore, when you look at the pullback entry, just take your 50-day moving average and then see where does the line lies. And here, if you see the bounce back in an uptrend, then it's a good signal that you can buy it, right? But if the price moves towards the 50-day moving average and falls further in a downtrend, then it's a shorting opportunity, so you can take a short. So that's step number 2. That says look for a pullback entry, which means you can buy on pullbacks, but then use your 50-day moving average to confirm your pullbacks, whether it's an uptrend or a downtrend. And if it's an uptrend, you buy the uptrend because you're taking a position, a long position. But then if it's 50-day moving average that confirms a downtrend, you take a short position because you're expecting a bearish momentum on that trade going down. The third step, you use your relative strength index as well as your moving average convergence and divergence. Your RSI between 30 and 50 in an uptrend, a good buying opportunity. So your RSI between 30 and 50, in between that range, it's a good buying opportunity, right? But your RSI between 50 and 70 in a downtrend, it's a good sell opportunity. Because it means now you are going down because you've caught the movement, that is a downward movement, but then you use your RSI to track where are you within the RSI so that you understand is it an exit or is it an entrance. And if you use your moving average crossover, right? If you look at the blue line, which is above orange, it means that's a bullish signal. But if you use your MACD crossover and your blue line is below orange, it means it's a bearish signal. So it's important then when you take your moving average convergence or divergence, when you put them up, you understand that if you are crossing the blue line, or sorry, you're below the blue line, bearish. You're above the blue line, bullish. So above, bullish, below, bearish. And step 4, to set the stop losses and the profit taking now, that's the risk mitigation that I've spoken about, that you have to have risk mitigation and measures. So for stop losses, you always place it below the recent swing low in an uptrend, or above the recent swing high in a downtrend, right? So it's important for you to understand where you would put your stop loss, because you want to protect your trade. You enter the trade below the recent swing low, that is the swing that went to the bottom of the trade before it researched. That's where you put your stop loss, right? But in an uptrend, in your recent swing high, and you are going down and you are shorting, then it means you are going to take it on your swing high on a downtrend if you are shorting in terms of the trade that you are taking. And your profits, it's recommended that your risk-reward ratio should be at least 1 to 2, right? You get twice as much as you are willing to risk, or 1 to 3. This is where it becomes important to be able to control yourself, because you may just think that if the token goes up, you can sit and decide what percentage of the profit you are taking. It doesn't mean you exit, but your 1 is to 2. That's where you put in your risk mitigation, and then you decide how you take your profit. Now, when you enter, we've got something that we called dollar cost averaging, which is DCA. Dollar cost averaging means you decide the proportion of the value of the investment that you want to invest on that 100%. You can decide that my initial position will be 20% of what I'm using. If it's 100 Rand, you use two rands and to get in, and then you are remaining with 80. You decide that the next entrance could be 50. You remain with 30, and then after confirmation of the trend that you want the last 30 in. But how you break that 100%, it depends on you. But rather than you go in all at once, because when we get and take a position, you take a position sometimes because you've got your confirmations and therefore you are bullish, but not that the trend has already reversed. You are losing momentum on the trend, and therefore the trend is about to reverse, and therefore you dollar cost average going in. So it's then the same thing that you would do in your profit taking, that when you take your profit, depending on what you've put in your strategy, you would decide at a certain point, if I've made so much percentage up, I take certain percentage down. What I mean for that, if I take a position and the position will go up by 50%, right? Maybe in your strategy, you will say, if I go up by 50%, I take 20% profit. And therefore, if your investment still continues, you decide what percentage you take up until you take all of the initial capital that you've invested. And if the trend still continues to be profitable, you can then decide what you do with the profit. But the advantage is then you are using the exchange's money. You're no longer using your own money. You've secured your money back, and now you are just taking profit on what the exchange is doing. That is very key. The quicker you can get the money that you've invested out, and therefore you are only left with the money that is the exchange's money, it's the better, because then you are risking the house's money, or you are risking the exchange's money rather than your own money. So it's very key how you take profit after you've entered the trade, because the quicker you are able to pull out your initial capital that you've invested, the safer it is that now you are trading the exchange's money, and therefore if that trade is liquidated, it is the exchange's money, but not your initial capital that you've put in. So keep that in mind and make sure that you put that at the back of your head in all of the tradings that you're doing. So for an example, if you look at a Bitcoin long, right? If Bitcoin is on an uptrend, maybe on a 50-day moving average above the 200-day moving average, prices pull back on the 50-day moving average and bounces back, the RSI would be at 40, which means it's an oversold uptrend, right? And therefore you would look at your moving average convergence and divergence, the crossover. And therefore, if the crossover happens, the blue line above the orange, then it means you can enter the buy position. Let's assume it's sitting at $40,000 US. You enter the buy position at $50,000. But you can then put your stop loss at 38,500, right? But then your take profit will be at 43,000. And therefore that risk reward then becomes the 1:2 that we're talking about, just as an example. But another example, if you're taking a short trade on Ethereum, if Ethereum is on a downtrend, and the downtrend means the 50-day moving average is below the 200-day moving average, and the price pulls back at 50-day moving average but starts falling, if the RSI is sitting at 60, which is overbought in a downtrend, and your MACD crossover happens in the blue line below the orange, it means therefore you can enter the sell at 2,500 and your stop loss should be at 2,600. But then you will take your profit at 2,200. And therefore that risk reward is a 1:3. 1:3. So these are just the example on how you will do your risk mitigation and how you would then set up those risk parameters, right? And then thirdly, your risk management and capital protection rules. So your risk management and capital protection rules is bullet point number 1. It's key that you only take 1 to 2% of your trading capital per trade. Don't overexpose your capital. And use stop losses to limit your losses. So your stop loss orders help you to limit your losses and never overtrade. Stick to the quantity setups that you've put in. Even if there is FOMO, the fear of missing out, and people are shilling the coin, it's going to the moon, always stick to your strategy. Always make sure that you don't overtrade and stick to quality setups that you have put in. And make sure you're not emotional in the process. And then diversify your trades. To avoid putting all capital in one asset, diversify. For example, if you have $10,000 trading capital and you risk 1% of that portfolio on a trade, it means your maximum losses should not be more than $100, right? Because it's 1% of the $10,000. And then the fourth point is the trading psychology and mindset. So you have to control your emotions. So that's why I want to talk about the fear and greed. It's important for you to understand where the mindset of the investors are. But one thing that's dangerous in trading is fear and greed destroy traders. Fear is you've done all the right setups, your technical setups, and the trade doesn't move what you expected immediately, and you decide that you're going to lose money, let me pull my trade. Or the trend is not confirming at a technical level what you are hearing people talking about on Twitter and social media, and you decide that let me go in and the trade goes further down. So fear and greed, it's important that you manage yourself and control your emotions and never revenge trade. And then stick to your plan. Follow your strategy and not impulses. The best traders are the traders who are able to follow their strategy even if they steal money on the table. Because those traders, in trading, you never go wrong when you take profit. Where traders make losses is when they have not taken profit and the trade consumes everything that is there. So think about it this way. When you follow your profit strategy or profit-taking strategy, you can't go wrong when you take profit. Yes, psychologically you will think, why do I take the money now at this point? If I were to wait a little bit, maybe it might double up and I can get a better incremental value on it. Be careful of greed. Fear and greed moves emotions, and emotions are dangerous in trading. So it's important for you to follow your strategy, not impulses, and accept losses. Losses are part of trading. Manage them properly. Never revenge trade. You will lose because the market has gone the opposite direction of your expectation and you decide that now let me go in and take another position. Maybe I might catch it on its way down. Don't revenge trade. Often when you get to the point where you've made losses and you feel you are emotional, step away from the trading desk, do something else, compose yourself, and get back to trading. So it's important for you to control your emotions. If you lose 3 trades in a row, take a break and analyze what went wrong instead of revenge trading. And then the last one, identify the trend direction using moving averages. So it's key that you understand your trend directions will be identified through moving averages, your MAs. And then wait for the pullbacks between entering the trades. And your pullbacks, you know that you are using your MAs, you split between maybe a 50-day moving average versus 200-day moving average, and you can do your confirmations, but just make sure you understand what technical tool you use for it. And use your relative strength index and your moving average convergence and divergence to confirm the entry. So your RSI and your MACD, they will help you to confirm your entry. And then set stop losses and follow your risk-reward ratios. Maintain the discipline and avoid overtrading. Maintain your discipline and avoid overtrading. And this strategy works in all trading environments. Whether you are trading Forex, you are trading crypto, you are trading stocks, you are trading commodities, these are the basics of trading irrespective what asset are you trading. And it's very key. Now, these are more focused on the technical indicators that you will be using when you are using TradingView. Now, TradingView, also like an exchange, has a demo account. And therefore you can go on TradingView and open up a demo account and start to play around with these technical tools. At some point, I will be offering training. I was asked by one community member from the beginning about training because they would like to have an intensive training that just focus on assisting various traders. I'm still thinking about it. I think when the numbers are right, then I'll be able to make an announcement. But please check the space because there could be very exciting announcements to make. Take these into account, what I've just said, jot them down, and refresh yourself every time. Drop me comments down below. If there are questions that you would want me to explain a little bit further, please ask, and then I will, in the next episodes, provide more information. I hope this has helped. I wish you profitable trades. Bye-bye.